All right, welcome to this month's monthly market trends video for the month of May. Big question we always asked is Kevin, what's the market doing? Is it going up? Is it going down? Where should we go? What should we do? We're going to break that down for you. We're going to give you the details of what you need to know about the market here in the Colorado Front Range. Hi, it's Kevin Shoemaker with eXp Realty. As always, we're going to bring you the numbers. We're going to bring you the information that you need if you're considering making a move, whether that's moving into the Colorado Front Range, whether that is you're currently living here and looking at making a change, or maybe you're making a move and transitioning out. Whatever your needs are, we're here to help you out. We're going to break down the numbers and give you that information. So let me share my screen and we'll get started here. So. Today, 70% of Americans are concerned about a potential housing crisis and a crash in 2025. That's what we're going to talk about today is the numbers. And so you have the information so you know what to do and then how to make those decisions. And what we do know is that 32% of those that are planning on making a major purchase are now considering delaying that. And that's because of the unknown, because they don't have the information. And that's the information that we want to bring to you. We want to bring you the national perspective as well as the local numbers, and so you can make decisions for you and your family. So when we talk about home price, that's always the big thing is are the prices going up or are they going down? Well, on a national level, when we look back over the last year, they were at 7% a year ago, and now we're tracking just right below 4%. Nationally. Now, as I've shared with you historically or in previous months, I showed you some of the maps in the different regions. So there's really 4 or 5 different quadrants that we track in the U.S. of growth. And when we look at like the Northeast right now, they're lagging. The market's much slower in the Northeast. And even if you look at even the Southeast, they're rather flat. And even and we look at the far West in the California market. They're still flat. There's some unknowns in their marketplace right now. But when you look at the central piece, when you look at the Midwest, when you look at the Rocky Mountain region, we're actually ticking up above what many people have predicted. So we're really have a very strong market, and we continue to believe that market's going to be strong through the spring and the summer months. Now, the supply of homes our supply is still low. And a lot of people go, well, they talk about again the housing crash. Are we going to crash? We don't believe that's going to happen. The reason why is we don't have inventory. I was talking to my son this morning. He shared an article with me, and he was trying to compare the market today compared to 2008. The biggest difference is inventory. When you look at 2008 in the crash, we had a significant level of inventory, and we had financial distress. No one could get loans. Today, when we look at the homeowners and home ownership, over 50% of homeowners have over, I believe it's 52% of homeowners have over 50% equity in their home. Over 42% of all homes owned are owned free and clear. So when you look at those numbers, there's very well qualified and financially strong buyers and sellers out there because of the equity position and the amount of equity that they've gained over the last 5 and even 10 years. So here we look at our supply, and we see this time last year, today we are, compared to this time last year, we have 30% more inventory than a year ago. Now, when we look at this time at pre-pandemic levels, our inventory today is actually 16% less than what it was pre-pandemic levels. So we still have a really low level of inventory. Many people say, well, just build more homes. The challenge there is they are building, but you have land costs are higher. You have the cost of construction is much higher, labor costs, material costs, permitting, the time it takes to build. So as you build and you have new construction homes, you have existing and you have new construction. Typically, there's about the difference between a new construction and an existing home is about 10 to 15%. And so as the price of new construction goes up, you have the gravitational pull of pulling the existing market up. What happens is you also have the tolerance of what can the consumer afford and tolerate. And that's really where we are. We're really battling affordability. And that goes into interest rates, which is another thing that we're going to talk about. So when we talk about, we talk about the Federal Reserve and we say, okay, well, what are they going to do? When are they going to lower rates? Because that was the big thing, prior to our recent election, everyone was anticipating rates going to come down and rates were going to come down, and our market went really flat. Once the election happened and we started to know and expect, like, okay, we think we know what's going to happen going forward and what to expect. But but now that we know sort of what what's coming down the road, then we can now predict that, okay, it's not likely that we're going to see rates at 4 and 5%. But what are those rates going to look like? Here we show inflation, and we show that inflation, it has ticked down, and now we're stabilizing a little bit. That's a big thing that the Fed looks at. The second thing is they look at unemployment. So they're trying to say, okay, is unemployment rising or lowering? And that's how they're trying to moderate and figure out if they're going to do any rate cuts. The Feds believe the Feds are going to do 3 more rate cuts this year. Probably is not going to happen until more mid-year, where we see our next cut. Now, when you look at the rates, when you look at the bottom here, you look at the bottom in the graph, the lowest point to the highest point, we're only talking about a 0.5% swing in that market, in the market volatility. But you can see we had an uptick in May in interest rates, but actually as of this week, we started to see a little bit more of a tick down. So yesterday I had a client coming in from Texas, and they were able to lock in at 6 5/8. So you're really seeing in that 6.5 to 6 3/4 is sort of where we are right now on 30-year fixed interest rates. Here, these are the projections of what a lot of the big players in the market are believing for second, third, and fourth quarter, finishing out somewhere in the 6 and 3/8 to maybe 6 3/4 range is where they're predicting for the year. Now, here, this sort of gives you more of a graph, and again, you have sort of mixed opinions, but this sort of shows you that everyone's predicting we're going to be above 6. So I would say it'd be safe to say year in, that we're going to be probably somewhere in the 6 1/4, 6.5, and then they're projecting even through the end of 2026, through the end of next year, that we're going to probably still be in that 6-ish to maybe 6.5 range. So the days of 4 and 5% are just not likely. And also what we know is that there's been a lot of people sitting there with a lot of equity in their home. They've outgrown their home. Maybe their home they've expanded their family and they need space. Maybe they've been looking to downsize and they've been waiting for rates to come down because they're sitting at maybe 3% interest rate. The reality is 6% is going to be our norm. And so the sooner people realize that, they're able to then make decisions going forward of what they do and how they can move forward and make decisions in their for them and their family. Now, when we look at closed sales, so we're going to dive into the local market. So here we look in the blues, Fort Collins, red, Loveland, and then yellow's Greeley. So when we look at closed sales for last month, for the month of April, we had 302 closed sales in Fort Collins, 257 Loveland, 261 in Greeley. You can see we had a spike in Fort Collins, and then we started to see same with Loveland, and then Greeley flattened out just a little bit in sales. Pretty typical for our seasonality curve. Here you look at under contracts. So again, you can see how we had a spike and then in March, and then we are under contracts. That's sort of the pulse of the market. So we close sales, typically when you go under contract, there's about a 30 to 45 day transition from under contract to close. So this shows you that we had a little bit of a dip in April as far as under contracts. New listings, you can see the surge. We have a surge of inventory, pretty typical for the cycle, and then a little bit of flattening out. Some of that can go to weather. We had some cold fronts, a little bit of unpredictable weather that we had. Again, we've had a ton of rain and moisture, pretty typical for May. So we're really going to start to see things pick up here as we go into the June market, especially after Memorial Day and as kids get out of school. Here's our inventory of homes for sale currently. So currently sitting at 641 homes in the Fort Collins market, 675 in Loveland, 616 homes currently for sale in the Greeley market. Average days on market, we're looking at somewhere in that 45 to 50 day range. You can see the drop again, pretty typical for as we go into the spring market. We're going to see the average days on market decline. Months of inventory, we always say that between 5 and 6 months inventory is what they call a normal market. When you have below 5 months inventory, that's going to be a seller's market, meaning that it's tipping to the advantage of the seller. When you have more than 5 or 6 months inventory, that's going to be more of a buyer's market, meaning that there's a surplus of inventory, and means that buyers are going to have more negotiation power and more room to negotiate compared to the sellers. Right now, again, we're sitting right around really close to three months, pretty equal for all of our markets right now. So again, tipping to the seller's market. And then here we have average sales price. So we can again see that we, in general, with the exception of a little dip in Fort Collins, we're starting to see that average sales price continue to climb. So 636 in Fort Collins, 639 in Loveland, and 536 in Greeley. So when you look at affordability, many people are taking advantage of a lot of the new construction and development that's going on the far west side of the Greeley market, where you can save $100,000 over what you can get for the same home in the Fort Collins market, and splitting the difference is Loveland. So a lot of new construction opportunities. Again, there's just been a lot of new development, a lot of new growth, a lot of new master plan communities, especially some great areas in Windsor as well. So if you're looking for some master plan communities and some things and amenities for you and your family, obviously there's a lot of options. So again, we're here to bring you the numbers. We're here to help you make decisions. When you have the information, when you know the numbers, you can make good decisions. Feel free to also click the link below to visit our home evaluation site if you're curious of what your home would sell for in today's market. Check out the site, or also if you'd like to take a gander and have a backstage pass to the MLS, hit our Find Homes in Northern Colorado feed, and you'll have a backstage pass to search for all the homes in the inventory in Northern Colorado to check out some of the latest and greatest options out there. So again, Kevin Shoemaker, we appreciate your time. We appreciate your loyalty, all the referrals for all of the clients that are past clients that have helped us out, and we're here to help you and here to serve.